Hi everyone, today we'll be discussing about relevant information for decision making with a focus on operational decisions.
Our learning objective is use a differential analysis to examine income effects across alternatives and show that an opportunity cost analysis yields identical results. These are sample operational decision questions. Should Toyota make the tires it mounts on its cars, or should it buy them from suppliers? Should General Mills sell the flour at Mills, or should it use the flour to make more breakfast cereal? Should Air France add routes to use idle airplanes, or should it sell the planes? These decisions all require a good deal of accounting information, but what information will be relevant to each decision? Definition of terms. Differential cost. The difference in total cost between two alternatives. Differential revenue. The difference in total revenue between two alternatives. Differential analysis. A decision process that compares the differential revenues and the cost of alternatives. Incremental analysis. An analysis of the incremental or additional costs and the benefits of a proposed alternative compared with the current situation. Incremental costs, the additional cost or reduced benefits generated by the proposed alternative in comparison with the current situation. Incremental benefits, the additional revenues or reduced costs generated by the proposed alternative in comparison with the current situation. Outlay cost, the cost that requires a future cash disbursement. Opportunity cost, for a resource that a company already owns or that it has already committed to purchase. The maximum available benefit forgone or passed up by using such a resource for a particular purpose. Analyzing relevant information focusing on the future and differential attributes. Opportunity, outlay, and differential costs and analysis. When we study and compare differential cost and differential revenue, we will come up with differential analysis. When managers analyze the differential cost between the existing situation and the proposed alternative, they often refer to this as incremental analysis. For instance, suppose Nantucket Nectars proposes to increase production of its Nectar Fizz juice drink from 1,000 bottles to 1,200 bottles per week. The incremental costs of the proposed alternative are the costs of producing the additional 200 bottles each week. The incremental benefits are the additional revenues generated by selling the extra 200 bottles. Alternative approach using opportunity cost instead of incremental analysis. Opportunity cost applies to a resource that a company already owns, so its use requires no additional cash disbursement. We define opportunity cost as the maximum available benefit forgone or passed up by using a resource a company already owns for a particular purpose instead of using it in the best alternative use. Example: Maria Morales, a certified public accountant employed by a large accounting firm, got a salary of $60,000 per year. She is considering an alternative use of her time, her most valuable resource. The alternative is to start an independent accounting practice. Maria's practice would have revenues of $200,000. This is $140,000 more than she would make as an employee of the large firm. However, she would also have to pay $120,000 to rent office space, lease equipment, buy advertising, and cover other out-of-pocket expenses. Now let us try to observe how we came up with incremental analysis and compare it with opportunity cost approach. Assume Maria opens her own independent practice. She would make 200,000 in a year if she would open her own practice, and we deduct 60,000, which is how much she makes in a year as an employee. So there will be an increase of revenue of 140,000, less the incremental cost of 120,000, so the incremental income effects per year is 20,000. Let's compare it with the opportunity cost approach. Revenue is 200,000 less outlay cost of 120,000 and opportunity cost of 60,000. So the income effects per year is 20,000. These two approaches yields identical results. What's the difference? Why do we use opportunity costs when an incremental analysis produces the same result? When there is only one resource and one alternative opportunity to use that resource, the incremental analysis is more straightforward. However, suppose you were analyzing a project that uses 5 existing machines, each with 10 alternative uses. An incremental analysis would require comparing the project with 105, that's equal to 100,000 alternatives, every combination of alternative uses of the 5 machines. Using opportunity costs allows you to simplify the analysis. You just assess the 10 alternatives for each machine, pick the best one to use in determining each machine's opportunity cost, and add the 5 opportunity costs to the outlay cost of the project. The opportunity cost approach is simpler than the incremental approach in such a situation.
That ends our discussion, and I hope you learned something new. God bless everyone.